Have you ever noticed how price almost magically reverses right after hitting your stop loss, only to move exactly in your original direction? If yes, congratulations! You've just witnessed the invisible hand of liquidity. In this video, I'm going to uncover one of the most mysterious yet shockingly accurate trading strategies, the Liquidity Magnet Strategy. This is not your usual moving average crossover or RSI divergence trick. This is about understanding why the market moves and where it must go next. Stay till the end, because once you see the market this way, you'll never look at your charts the same again.
Let's start with the basics, but not in a boring way. In trading, liquidity simply means how easily you can buy or sell without moving the price too much. But in smart money terms, liquidity is fuel. Think of the market as a giant ocean. Big players, hedge funds, institutions, are like whales. They need massive amounts of liquidity to enter or exit a trade without causing a splash. Where do they find that liquidity? At the places where most retail traders have their stop losses. That's why price often moves just beyond obvious levels to grab those stops and then reverses. It's not manipulation, it's simply the business model of the market.
Here's the magic. Price is attracted to areas of high liquidity, like a magnet. Imagine clusters of stop-loss orders resting above a recent swing high or below a recent swing low. These are liquidity pools. Market makers know this. Algorithms see this. So what happens? Price hunts these zones. Once that liquidity is grabbed, the magnet effect ends and the real move begins in the opposite direction. That's why traders say the market moves to where the orders are.
Let's break it down using human behavior. When price forms a double top, retail traders assume it's resistance. They short at that level, putting their stop just above the high. But smart money sees this as an opportunity. They push the price just slightly above the resistance to trigger those stops. This is called the liquidity sweep, and then drive price downward with their own sell orders once the liquidity is collected. To the untrained eye, it looks like a false breakout. To the smart trader, it's the perfect entry. Now, let's get practical. You can spot liquidity magnets by looking for equal highs or equal lows. When you see two or more swing highs or lows at the same level, that's a red flag. Stops are accumulating above or below. Trendline liquidity. Retail traders love diagonal trend lines, but every bounce on a trend line means more stops below it. When the line breaks, that's a liquidity grab waiting to happen. Session highs and lows. Look at previous day's high or low, especially in London or New York sessions. These are prime liquidity targets. And order blocks and imbalances. Combine liquidity zones with institutional footprints like unfilled imbalances or strong order blocks. It's like finding treasure with a map and GPS together. Let's visualize a scenario. Price is trending upward. You spot a clean double top at 1.2350. Everyone shorts there, with stops above 1.2360. What happens next? Price spikes up to 1.2365, takes out the stops, and immediately reverses down to 1.2280. Retail traders cry, "Freak breakout!" But smart traders? They just got filled at premium liquidity following the Liquidity Magnet Strategy.
Here's how to trade this step by step. Step 1. Identify a clear liquidity pool, equal highs, lows, or obvious stops. Step 2. Wait for price to raid that level. Step 3. Watch for a strong rejection or market structure shift on lower time frame, like 5M or 15M. Step 4. Enter in the opposite direction. That's your post-liquidity entry. Step 5. Target the next internal liquidity area or imbalance. Bonus tip. Use time confluence. The best liquidity grabs usually happen near major session opens, like London or New York.
This is where 90% of traders fail. Most traders become the liquidity because they place trades at the same obvious levels as everyone else. You need to think like a liquidity hunter, not a liquidity provider. Don't enter on breakout, wait for the stop hunt. Don't place your stop loss right above equal highs. Instead, give it breathing room. Don't trade emotional candles. Understand the story behind them. Remember, the market's first move is usually a trap. The second move is the real direction. Here's where it gets deeper. Combine Liquidity Magnet with smart money concepts like order blocks, fair value gaps, and market structure breaks, and you get a sniper system. For example, if liquidity is taken above equal highs and you see a bearish order block form right after, that's your high probability reversal zone. You're now trading with the big players, not against them.
Here's the fascinating part. The liquidity magnet strategy isn't new. It's been part of institutional algorithmic logic for decades. The reason it feels mysterious is because it's hidden in plain sight. Every candle, every wick, every breakout is a story of liquidity being hunted or delivered. Once you start seeing that story, you stop being emotional. You start being logical. And that's when consistent profits begin.
Even the best concept fails if you misuse it. So avoid these traps. Chasing every wick. Not all stop hunts are trade opportunities. Wait for confirmation. Ignoring higher time frame bias. A liquidity sweep against the overall trend often fails. Trading without context. Always align your liquidity levels with market structure and session timing. Let's summarize this powerful concept. Price is drawn to liquidity, like a magnet. Liquidity zones form near equal highs or lows, trend lines, and session extremes. Wait for a liquidity grab plus structure shift before entering. Think like smart money. Trade after the trap, not during it. Always trade within context, combined with market structure and timing. Remember, the market isn't random. It's engineered to seek liquidity. Once you understand this truth, you'll stop fearing stop hunts and start using them.
If this strategy blew your mind, give it a try on a demo chart. Watch how price reacts to liquidity zones before your eyes. And if you found this video helpful, hit that like, subscribe, and drop a comment saying, "I trade with liquidity." Because the next video will go even deeper. We'll decode how to combine this with FVGs, fair value gaps, for sniper entries. Until then, remember, don't chase the market. Let the market come to you. Because where the liquidity lies, the money follows.